So we talk about the market being a leading indicator. And that's actually very difficult because we still have headlines of saying that there's a recession. And we think that the recession is coming. If you wanted to pin us to a date, well, we would go from what our economist is providing sometime in April 2023. But this is all probabilities. It could be July. It doesn't really matter. It's just that there is likely a actual full recession coming on. One that we're not going to debate on what the definition of a recession is. The market is already pricing in a lot of that. It's one of the reasons that we're not saying, hey, there's a recession, let's just get out of the market. Now, once that it becomes a certainty, you will still see some downward movement in the market. So we got to realize that. But as a leading indicator, once we're in that full recession, and once the Fed begins to pivot and start to lower interest rates, that's whenever you would see the beginning of the uptrend in the financial markets at the very low trough of a recession. And I think we're getting into that in the first half of 2023, and we want to position for that. So we're looking for that 50-day to come over the 200-day. We're looking for money supply to begin to not stagnate and be actually at negative growth, but begin to be positive. We're looking for the yield curve to move up and actually be positive. And those are the signals that we're going to use to go ahead and start redeploying some of those defensive positions into an economy that's about to rebound. So it's watching the Fed. It's determining how long the Fed's going to do it. And a lot of that data is starting to indicate that the Fed is going to pivot sooner rather than later, though there's some politics and some jawboning that they have to go through, and they certainly have to remain credible. But we're looking for some of these positions to change so that we can start to get invested prior and during the recession. And emotionally, that's going to be difficult. We're going to have to get aggressive and risky at the time where it's going to be at its darkest hour. So just know that, but that is the way that we're doing, and we're positioned already for it. Sure, we will participate in downside because we can't abandon the investment opportunity set altogether. We do have some defensive positions, and most of the time the market's in an upward trend. We're eventually going to get there. These downward trends, you measure them in months, you measure bulls in years, and we're probably getting late in the season of this bear market.
Because that inflection point, when it happens, will look really obvious looking back on
Yes.
it. But beforehand, heading into it, it's not going to be nearly as obvious.
You're going to feel very much a lot of despair at that moment whenever recession, unemployment showing up in a big way, and you're no longer talking about inflation, you're probably talking about deflation because prices of everything is falling, and that needs to happen, really. And we're positioned for it. We're more value tilt. We have cash. We still will participate in the downward market movement as well because we do have exposure to the market. But these are the things that we're looking at to be constructive.